Good day. Welcome to another session of Fog Accountancy Tutorials. Today I'm going to continue our study on IAS 38, Intangible Assets. And we're going to specifically dwell on Goodwill. Now, what is Goodwill? Now, this is what I would say, or this is how I would define Goodwill. Goodwill is an intangible asset, which represents all the factors that enable a business to operate successfully. I repeat, Goodwill is an intangible asset which represents all the factors that enable a business to operate successfully. Now, in other words, what I'm trying to let you understand is that goodwill is the difference between the value of the business and the value of its net identifiable assets. Okay, so let's say the value of a business is $300 million. But if you sell the assets individually, separately, you are going to have, or you're going to get 250 million. So in other words, the buildings, the machines, and any other assets that are there, the net assets can be sold and we realize 250 million. But we are saying that the value of the business entirely is 300 million. So if the net asset is going to fetch us 250 million, but the business is valued at 300 million, then the extra 50 million is called goodwill. That is what we are trying to say. So in other words, this 50 million represents all the factors that enables this business to operate successfully. And it includes the good reputation or the quality service that they provide, the customer base or customer assurance that they have, and maybe expertise, the management expertise that they have. You know, any factors that will make other people, society, or the business world see that this business is unique, they have value, and that is what we call goodwill. So goodwill basically is about certain factors that are existing in the business, even though they are intangible, but we want to quantify them and add it to the value of a business. And we will describe that as goodwill and then recognize it in the financial statement as a non-current intangible asset. That is what we mean by goodwill. So I said that goodwill is an intangible asset which represents all the factors that enable a business to operate successfully. Now, there are two types of goodwill that can exist in the business. We have the purchase goodwill, and then we have the non-purchase goodwill. The non-purchase goodwill is also called internally generated goodwill, IG goodwill. Now, we have the purchase goodwill and we have the internally generated or the non-purchase goodwill. These are two examples of goodwill. Now, so let me explain them one by one, the purchase and the non-purchase goodwill. I want to take them one by one for you. So like I said, we have the purchase goodwill and the non-purchase goodwill. What is purchase goodwill? Now, imagine that you are selling your business, okay? And like I said, the identifiable, or you are going to buy a business. So you want to take over a business, and then you negotiate for the purchase consideration, the price at which you are going to buy the business. It's called the purchase consideration. So you realize that the net identifiable assets of a business, if you take the land, the building, have the property plant that way, property, their inventory, the receivables, payables, that's all like then worth 200 million. To buy. So let's say the purchase consideration. The purchase consideration, the person says, it's 200 million. I'm going to sell the company or the business for 260 million. Now, if you are willing to pay this 260 million, even though you are aware that the identifiable net assets are 200 million in value, then you should be sure that that 60 value for money. In other words, the company that you are going to buy has certain factors that is enabling the environment of the business to operate successfully. In other words, they already have some good and committed customers that the new owner will continue to deal with. They already have some management expertise that they are going to deal with. They have a good brand name and quality service that is accepted by society. And all those factors are enabling the business to operate successfully. And because you are going to buy the business, even though the identifiable net assets is 200 million, but because you are going to enjoy those other factors, you need to pay more. The extra 60 million that you are paying for, which you are gladly paying for, is called goodwill. Now, because you are buying the business, you are going to put this 60 million on your financial statement as goodwill. The extra you have paid in excess of the net identifiable assets to buy the business is called goodwill. So purchase goodwill is the excess of the purchase consideration over the identifiable net assets of a business. I repeat, purchase goodwill is the excess of the purchase consideration over the identifiable net assets of a business. That is what we call purchase goodwill. So this kind of goodwill is usually not valued except there is a sale of the business. Someone else or another person or another business is taking over the existing business. Then there should be a valuation of goodwill, and then we recognize that in the financial statement because we actually paid money for those factors that is enabling the business to operate successfully. And I told you earlier that those factors that enable a business to operate successfully is called goodwill, and it's an intangible asset which needs to be recognized in a financial statement when it is being paid for. And that is what we call purchased goodwill. I'm also going to talk about non-purchased goodwill. So in summary, I will say that the purchased goodwill only occurs when you are buying a new company or you are taking over another business, and that is where you pay for purchase goodwill. And then also it also includes the goodwill that arises on consolidation in the case of group accounts. And then also know that purchase goodwill will be recognized in the financial statement. That is the summary of the purchase goodwill. Now let us quickly look at the non-purchase goodwill. So non-purchased goodwill, or what we call the internally generated goodwill. Now, when it comes to the non-purchase goodwill, I have already explained that the non-purchase goodwill is about the goodwill that has been generated from the business. Like, as you have no intention of selling your business, there is no group account consolidation, you are just operating as a company or as a business, and you have operated over time and generated some factors that is enabling the business to operate successfully. And so, yes, you know there is goodwill, but it has not been valued, and there is no need to recognize that in a financial statement. So non-purchase goodwill is the one you have generated internally and you didn't buy it as a result of a takeover. Now there are three things you should note when it comes to non-purchase goodwill. Three things. The first one is that it is called inherent goodwill. So it is called inherent goodwill. It is also known as inherent goodwill. So that means that it's a goodwill that is in the business as you continue to operate. Very, very important. Then the next thing you should know is that it has no identifiable value. So the non-purchase goodwill has no identifiable value except there is a valuation of it. And that valuation usually does not occur except there are some changes in the business, being it a merger, a takeover, or something that is very significant. Other than that, non-purchase goodwill has no identifiable value. And the final and the most interesting part is that it is not recognized in the financial statement. So it means that non-purchase goodwill will not be recognized in the financial statement of the business. So these are key things that should help you understand the non-purchase goodwill as opposed to the purchase goodwill, which has an identifiable value and which is recognized in the financial statement and which is not inherent. It was bought as a result of a takeover. So that is the difference. So that is about the non-purchase goodwill. And so like I said, this is not recognized in the financial statements. So having understood this, then let us also look at the accounting treatment for goodwill. And remember that I have already said that the non-purchase goodwill will not be recognized in the financial statement. And therefore, if we are talking about accounting treatment for goodwill, then we are basically referring to the purchased goodwill. So I'm going to look at the accounting treatment for purchased goodwill, because the non-purchased goodwill, we have established that it should not be recorded in the financial statement. So how do we treat goodwill in the financial statement, or purchased goodwill in the financial statement? Now, the standard IAS 38 provides 3 different instructions on the treatment for goodwill. Now, the first one is that it should be recognized as an intangible non-current asset in the financial statement. So it should be recognized as an intangible non-current asset in the financial statement. So purchased goodwill will be recognized as an intangible non-current asset. That is the first instruction. Now the second one is that it should not be amortized. Very, very important. We all know that the fall in value of an intangible non-current asset is called amortization. So yes, once it's an intangible asset, it should have been subject to amortization. But the standard says that purchased goodwill should not be amortized. And so we don't touch it. It doesn't fall in value. We don't put a useful life whereby we apply the principle of amortization and then find annual amortization charge to be recognized as an expense in the income statement. We don't do that with the purchased goodwill. However, we do impairment test annually in accordance with IAS 36. So the final principle is that it should be subject to impairment test. Annually, in accordance with IAS 36. So it should be subject to impairment test annually, or even frequently, when you think that the conditions are necessary, the conditions available, the picture is likely to have impaired. And so we do impairment test on the purchased goodwill annually to be sure if it's maintaining its value, and if there is any impairment loss, we write it off in the statement of profit or loss as an impairment loss, and then we reduce the value of the intangible non-current assets in the statement of financial position. And this is the instruction. So one, it should be recognized as an intangible asset, and then it should not be amortized, but you do impairment test annually. This is the accounting treatment for purchased goodwill. Okay. All right, so having understood the concept of goodwill, and then what we have learned from the previous videos, research and development, and the other issues relating to IAS 38, I request that we take this question and discuss this together so that we will try and enhance our understanding on what we've studied so far. Okay. Lendadell Limited is a manufacturing company located in Koforidua. The company is preparing its financial statement for the year to 31st December 2017. The company has incurred the following expenditure. So the first one, so we are looking at 3 expenditures, and then we will look at how to treat each of them. First one, a brand name for a specialist fruit juice, purchased for 250,000. By the year end, the brand specialist had valued this at 350,000 Ghana cedis. 2, the second expenditure. Lendadell spent 800,000 Ghana cedis developing a new line of non-alcoholic wine. 250,000 was spent researching the product before management gave approval to fully fund the project. And then the last one, training costs for the staff to use the new manufacturing process. The total training cost amounted to 180,000, and the staff have agreed to work for a minimum of 5 years for the company. Required. Discuss how to account for the above transaction in accordance with IAS 38, intangible assets. Okay, so these are 3 different expenditures. The job of you, the student, the examiner requires that tell him what you are going to do with each of these 3 expenditures. And so let us look at what we are going to do with each of them in accordance with the principles we have learned. Let's look at the first expenditure. The first one says a brand name for a special fruit juice purchased for 250,000. And then by the year end, it has been revalued upwards, whatever. Now, what I need to make you understand is that this brand name is a purchased brand name. So just like the purchased Goodwill, this brand name will be capitalized. If it was an internally generated brand name, it will not be capitalized, just as we studied with Goodwill. But because this is a purchased Goodwill, there was an outflow of resources to buy. And therefore, it must be capitalized as an intangible asset. That is the first thing you will see. And then you can also add this, just as we learned from the purchased Goodwill, that there shouldn't be any amortization of this brand name, except it has a definite lifetime or a lifespan. So if you are told that the brand name will last for 10 years, then you can do amortization by spreading the cost over the useful life. But usually, purchased Goodwill and purchased brand name, those ones do not have a specific lifetime because of the principle of going concern. We expect the brand to exist into a foreseeable future. And that is why the standard says that such purchased intangible assets should not be amortized. So you say that. Then also, you can also add the third principle, which says that there should be annual impairment tests. Okay? And so every year you test for impairment with this brand name, and then you see if it has been impaired, and you try and then write off the impairment as an expense and reduce the value of the brand in the statement of financial position. That is if there is an impairment loss. But remember that you are going to capitalize it at the cost of 250,000. We are going to use the cost model, not the revaluation model. So you should take note. The reason why we are using the cost model, even though we are told it was revalued, we are not going to use the revaluation model because a revaluation of intangible assets is only done when there is an active market. Okay, and in this case, it's unlikely that the brand will not be a homogeneous item. And therefore, we are not going to use the revaluation model. We are going to use the cost model, and therefore we recognize the 250,000 as the cost of the brand in the financial statement. Now let us look at the second expenditure. The second one says Lendadell spent 800,000 developing a new line of non-alcoholic wine. 250,000 was spent researching the products before management gave approval to fully fund the project. And so we are told that Lendadell has spent 800,000, okay, developing the product. So this 800,000 spent will be called research and development expenditure. That is what they have developed the product. There was a research component. But we are told that out of this 800,000, 250,000 is for research. So this amount was spent on researching into the product before approval was given for the development. But the 800,000 given is a combination of research and development. And if you take out the 250,000 from 800, you have 550,000. You can confidently call that your development expenditure or development cost. Now, what does the standard IAS 38 tells us? IAS 38 tells us that research costs should be expensed in the period. And therefore, research will be treated as an expense in the profit or loss statement. And only the 550,000 will be capitalized as intangible assets in relation to development expenditure in the statement of financial position. And therefore, you are going to capitalize the 550,000 as development cost, and you are going to write off the 250,000 as a research cost as an expense in the statement of profit or loss. This is how we are going to treat the second expenditure. Very, very understandable. So let us look at the last one. The last one says training costs for the staff to use the new manufacturing process. The total training cost amounted to 180,000. And the staff have agreed to work for a minimum of 5 years for the company. Now, listen and listen very carefully. I've said it before in the previous videos that training costs should be written off as an expense in the period. So we are not going to capitalize these training costs. No matter the category of training, once it's a training to improve employee performance, we do not capitalize it. Don't be misled by the fact that you are told that employees have promised to work for 5 years. And so thinking about that is going to be a lifetime of intangible asset for 5 years. No. You cannot restrict employee movement. And training costs, you cannot restrict the inflow and outflow of economic benefits that relates to training costs. So please and please again, once you see training cost in whatever form or type, it should be written off as an expense in the statement of profit or loss and not capitalized as an intangible asset in accordance with IAS 38. All right, so this is what the examiner expects from you, and you can even write more to make it look very beautiful. This is an analytical question, and you need to prove that you have understood the principles of IAS 38. Okay. And so, ladies and gentlemen, this brings us to the end of the part 4 of our video on IAS 38. Okay. Now, in the part 5 of this video, we are going to only solve questions. Okay, we are going to solve questions across the principles of IAS 38. Remember to subscribe to this channel if it is your first time. Share this video and let others also have a benefit. And until we meet again for another video or for the part 5, it's bye for now.